All right, all right. Good evening, traders. Happy Thursday. Welcome to the tail end of the week. Yeah. Market's going through market things. Hi, Perry. Good to see you. Hello to you, Bob. Good evening, Stephen. Everybody else. We're going to give it just another minute here. Make sure anybody who is logging in or possibly coming a little late. In fact, I might even real quickly, I'm gonna just, I've been doing this lately. I'm gonna go put the link in just in case anybody is trying to get in. Copy link. Meeting now. So, okay. I think we have everybody here. Great. Let's get into it. Let's get into it. Welcome to the Market Watch Group. Options, foundations. Today we are moving forward. Remember, we're now on a theory application type cadence. A few covered calls got called early. You know what? Let's talk about that. Remind me of that later on when we get towards the end. I want to talk about okay, what can we do with that? Covered calls is exactly right up the right in the wheelhouse of what we're talking about today. In our options foundations course, we're talking about selling options. So what have we done so far? We talked about basics, key concepts, definitions and terms, a general understanding of what are we buying when we buy options, who has rights, who has obligations. Then we moved into first order strategies. First order strategies are coming in as a buyer. So we talked about buying options. Yeah. Now what? Well, after we talk about buying options, a lot of people think, oh, well, then are we moving to spreads? No. We buy options, then we sell options, then we start to combine them. We're not going to talk about buying options, then spreads, then go back and be like, oh, by the way, this is what happens when you're a seller. We need to understand as a seller now. So covered call, as you'll see here in today's presentation, is a type of a option selling strategy. And Steven said he got called out early. What does that mean? We'll talk about it. And then we can talk about what might come next for him. Early exercise is not a bad thing. When you get exercise, when you get called out, that means you got exercise. We talked a little bit about the concept of assignment and exercising last week. As a buyer, you have rights. You have the ability to exercise your options. You're the exerciser. Now we're moving to sellers. Sellers have obligations. They are the exercisee. They get exercised, which means you are now forced to honor the obligation you entered into when you sold that contract. So we're just flipping the script, talking about it from that other perspective. And now we look at options not necessarily as a speculative instrument. I buy calls hoping for the momentum to go up. I buy puts for the momentum to go down. Now what? Now we're selling them for more of an income capacity. Time is on our side. Remember that time is the most consistent variable in how options get priced. Okay, let's dive in. Press, good to see you. Glad to have you coming back around. Press has a big show this weekend. We're all going to send positive vibrations your way so that everything goes as good as possible. Here's the disclaimers, as always. We're not brokers. We're not advisors. This is for educational and illustrative purposes only. And what is today's agenda? We'll do a quick intro. Okay, we'll talk about intro to selling options. Then we'll dive right into Steven's favorite covered call strategy. We'll talk about what it is, how you do it, what are the logistics. We'll understand the risks and the rewards. And then we'll do a quick comparison of covered call strategies. There's two primary covered call strategies. One is called buy right, and it's not RIGHT, like it's the right decision. Let's buy right. Nope, it's buy right. WRITE, write the contract. That means you buy the stock and sell the call, which is write the contract simultaneously. Versus what? Versus legging in. You buy the call or you buy the stock, you wait a week, 2 weeks, and all of a sudden you're like, you know what? Now is a good time. And then you sell the covered call. You leg into the covered call. You're actually not selling a covered call. You're selling a call that is covered. When you buy the stock and sell the call at the same time, that would be more of a selling the covered call all in one fell swoop. So we'll talk about the distinction. After that, we're going to switch gears and we're going to talk about selling puts. And we've all probably heard the term selling naked puts, and we're like, what? Naked? That sounds so exposed and dangerous. It's not. It's not. It has a different set of margin obligations, and certainly there are different levels of risk. But if you were to look just at the reward and risk profile for a cash secured put and a naked put, they look the same. And if you look at that and compare it to a covered call, that looks the same. What's changing is my capital requirement. I buy the stock, I got to put a lot of money up there. If I'm doing a cash secured put, I'm not going to buy anything, but I still have to hold that same, or at least very close to that same amount of money aside. If I do a naked put, now I'm using margin more, right? That's only available usually in non-retirement accounts. And you can do a cover, or you can do a naked put, which only requires like 20-25% margin. They're all very similar, and I don't think you'll ever find yourself in a scenario where you're just really stretched to the absolute maximum for your margin. So I think it's just a matter of finding which of them, if you like them, would you be most comfortable with. So that is cash secured puts and naked puts. Then we have risks and rewards. What is different about selling options? And then we will go into a summary. Please ask questions along the way. Comments, questions, concerns, just reach out. Let me know. And we will absolutely handle it. Otherwise, let's get into it. Introduction into selling options. What does this mean? What is the definition of being an option seller? This is the act of selling, or as I said, write, WRITING, writing the options contracts. If you're the buyer, you're not writing the contract. You're like, hey, I'm looking for a seller here. And the seller's like, great, I'll do it. And they write it up. They're obligating themselves. So of course you can't write up an obligation for them, right? This is for both calls and puts. There has to be a seller. So you're thinking to yourself, wait, is there just like always an inventory sitting around? No. The market maker's job, and this is a legal obligation, right? They had to pay good money to get a seat on the floor and become a market maker. Their job is to maintain a liquid market. So if you want to buy an option and you say, hey, I'm looking to buy this option, there doesn't have to be a seller. A market maker will become the seller by creating the contract in order to sell it to you. There's a chance someone may have that in their inventory. You don't know what their inventory is. You're not privy to that. You don't know if they own contracts here or there or anywhere else. But in the course of them being market makers, there's going to be a time where they're like, oh, somebody wants to buy 20 contracts. And they're like, great, I'll sell them to you. Well, they might have already just sold 30 to somebody else. Now all of a sudden there's 50 contracts, right? 50 contracts that if things go right and the market goes up, you're on the hook for those calls that you sold to them. So what do you want to do? Well, for every buyer, I want a seller. It's just like a bookie. If I were going to play basketball against LeBron James, he's getting a little old, so am I. We're both probably a little out of our primes. And then bookie said, all right, we're taking bets. Of course, everyone's going to bet on it. So what are the bookies going to do? They're going to change the odds. And they're going to be like, oh, well, if you bet $1 on Scott and he wins, you get 100. But if you want to make $1 betting on LeBron James, you got to put 100 down. If he wins, you get $1. Well, if he happens to sprain his ankle and he can't finish the game, that's a forfeit. I'm just saying. Like if I roll my ankle, I forfeit. You roll your ankle, you forfeit. Am I saying I'm going to purposely try to roll his ankle? I can neither confirm nor deny that would be my strategy. I'm just saying there's a chance. It's not like a foregone conclusion. Now, eventually, they might get to a point where they're like, look, you got to bet $1,000. And if you win, we'll give you $1. Or you bet $1, and if you win, you get 1,000. Because for everyone who bets 1,000, they want someone betting the $1, so they pay each other. And what does the market maker do? He takes the juice. There's a little vig, right? A little commission on both sides. I win. Everybody's $1,000 goes to pay everybody who bet 1. LeBron wins. Everybody's $1 who bet on me goes to pay those who bet 1,000. Now that's going to shift. Early on, it might be 100 to 1, and then it might be, and so different people get in at different times. But at the end of the day, somebody is there paying somebody else, and the market maker just takes the vig and walks away. That's what they want. They don't want to be on it. Now, in the meantime, they don't have the right where there's all of a sudden a surge of people betting on me. They're not going to not take the bets. They're going to take the bets and adjust the odds and say, oh, we better change these to start getting people on the other side. That's exactly what the market makers are doing with implied volatility. If everybody's selling, they need buyers. How do they attract buyers? They make the price cheaper. If everybody's buying, they need sellers. How do you attract sellers? You make the price more expensive. So if the implied volatility is low, the market makers are looking for buyers. They're not trying to trick us. They're legitimately looking for buyers. They're like, I got a bunch of sellers. I need somebody on the other side of this. How are they going to get it? Make it cheap. And now if we buy, they get to connect us with somebody else. And what do? They get the vig, the juice, the spread. That's what we're dealing with in our market. So now back to the task at hand. Now we are selling the market. Does that mean that there has to be a buyer? No, now the market maker is the buyer. He's always going to take the other side. We can always do this if we want to. If I want to buy, he's willing to sell it to me. If I want to sell, he's willing to buy it from me. And then he has to account for that in his inventory, and he takes that into consideration with what everybody else is doing, buying or selling. And that's his worry. That's his cross to bear. I don't got to worry about that. The importance of understanding strategies and risks. We obviously enhance our financial decision making by grasping the complexities of selling options. We are initiating the trade. We are obligated to the trade. We are collecting a premium from the trade. Those are the things that make this difference, but we need to understand those blocks so that when we combine it with buying options, we now have the ability to build some spread trades. We want to be able to mitigate risk, maximize opportunities through informed strategy selection. If you don't really truly understand what it is you're doing, yeah, then what are you pushing for exactly? Okay. Covered calls. What is a covered call? Covered call involves selling call options against an existing stock position. Remember, we're going to talk about two ways. So let's talk about buy right. Today, I buy a stock. Let me see what I have. Where we may have a little bit higher volatility. Okay, give me a second here. No, that's not what I want. I'm just going to take this one for example. Let's pull up. Let's talk about this and we'll do it. And then we're going to do more of it on Tuesday. What are we doing here? We're selling call options against an existing position. I own 100 shares. Whether I buy 100 shares today or I bought 100 shares a week ago or a year ago, I own increments of 100 shares. Why 100? Because contracts control 100. If you own 150, can you do 1.5 contracts? No, it's one. You want to do two, you got to buy 50 more shares and get yourself to the next level of round 100. 100 gives you one contract, 200 gives you two, 300 gives you three, and so forth and so on. So I am selling the right to somebody else. I own 100 shares of stock at 50. And I'm saying, hey, option trader, I'm going to give you the right to buy my stock for 55. It's at 50 now. What am I selling? An out of the money option. Are they going to pay me a bunch for it? No. Implied volatility is high. I'll get more than if implied volatility is low. So let's say implied volatility is high. They give me $2, $2. Great. That's mine. So if I have two contracts, I get $200 a contract. They give me $400 for the right to buy my stock at 55 in the next 35 days. It's at 52 right now. It's got plenty of room. If it gets up to 55 or 56, let's say, what's going to happen? I'm going to get exercised. This is what happened to Steven. Actually, it happened early. Normally, exercise happens on expiration, but what happened was those options that he sold were in the money. It's the strike is 55. It's at 56. It's a little before expiration. And they're like, I want it. Is the presentation not showing up? I sure hope it is. Can you guys see my screen? Oh, yeah. Are you seeing the covered call slide? Oh, no. I will in a minute. Perfect. I'll show you a visual representation. So what does a covered call do? It gives me the ability to generate income. It gives me some downside protection. If a stock's at 52 and I sold the $55 call and I get a $2 premium for it, imagine if my cost basis is 50. Well, my cost basis goes from 50 to 48. Whatever premium I sell against the stock that I own reduces my cost basis by that amount. Wonderful. That's fantastic. We love that. So the benefits here are covered call. I get income generation, a little bit of downside protection, and I still own the stock. Let me show you a quick representation of what this looks like. Okay, so I'm going to use AXP. I'm going to use AXP, and I'm going to buy 100 shares. Nope, that's XP. I want AXP. I'm going to buy 100 shares. Now that alone is going to cost me $22,000, right? 22 grand. Stock is at 220. So I'm going to also put in a April, and I'm going to sell a 220. Oh, they don't have 225s. I'll go to 230. And I'm going to do one contract. And here's the risk profile. Now, I have I have a fixed amount of gain. If I did this with one contract, the most I could make is about $1,000, a little bit more. Where does that come from? Well, I'm buying the stock at 220.50 and I'm selling the call at 230. So I can make about $9.50 from the stock going up. I also get paid $3 for selling the premium. So I get 9.5 and 12 and 3. So 12.5 is maximum gain. What if the stock only goes up to 225? Well, at 225 at expiration, the 230 strike is out of the money. It expires worthless. That means you keep the $3 that you sold it for and you're done. Are they going to try to take your stock? No. The stock's at 225. They had the right to buy it from you for 230. There's no benefit there. But you bought the stock for 220 and now you own it for 225. So what could you do? You could sell a call at 230 again. And you'll make more money this time. Maybe this time you make $4 or $5, right? And our cost basis starts at 220.5. That's this green number minus the 3. And every time we put another one on, they pay us more money. Steven, can you tell me the details of one of yours that got called out? Symbol, number of shares and contracts, what strike you sold, and what stock price you paid. Anything that's in here. What was the price you paid for the stock? What was the and we'll use a live example. I'm going to keep moving on the presentation and we'll come back to that because I do want to show like what would he be able to do next. Oh, he's going fast. All right, let's go in here and see if we can build this. AU. Okay. AU, and the stock was $18 he paid. He paid $18. And it was just one contract. And then he sold a 19 call. Was that for March or for April? Is it a bit of a gamble? No. Why? Because worst case scenario, you own a stock that you like cheaper than what strike was it? The 18. When you own the stock cheaper than you would have had it at. 19 strike. Got it. Okay. And how much you paid? How much did you sell that strike price for right there? Uh, 18 cents. $1,800. That's how much you paid was 1,800. Yeah. Well, when you sold the $19 strike price, what was your premium you sold it for? That's the final question. You sold that 19 put. What did they pay you for it? You collected 45. Okay, 45 cents. There we go. Boom. Now, here is the risk profile. No, what am I missing here? 100 shares and one contract. Buy 100. Oh, that's why I have a put. Sorry. There we go. There we go. I'm buying 100 of these. Wait, March 15th? Why am I not getting any variation here? I buy the stock. $17. Something's up here. Oh, sorry. Go to today. That's it. Now I'm now I'm where I need to be. Okay, so now then, the stock at the time was around $18, right? And you can see that, but you did this, if you did 1,800, paid, yeah, perfect. So what did you make? 145 bucks. 145 divided by 1,800 minus 45. Let's see, 1755. 8%. 8% in a month. So imagine if you have chunks of money. Now, does this require more than buying an option? Yeah. You're paying for the stock, right? You're paying for the stock. So in this situation, anything above 19, it doesn't matter how high it was. If it was at 19, he would get out. There's a 8% return. How did you get 145? Bob, great question. Bob said, how did you get 145? Because he bought the stock at 18 and sold slightly out of the money at 19. So that gave him the ability to make $1.45 for every $17.55 he put into the trade. There's that 8%. He got in around February 20th. So 1 month, 8%. 1 month, 8%. Well, 8% a month. I mean, if you're able to do 30% of your money at that rate consistently, that's 30% of your money making an 80% return. That's a great return. That's literally going to produce 24% on your entire portfolio just doing that. So that is, he gets 45 for selling the option. Then when the stock gets called out, he gets another $100. They're going to give him 19 for what he paid 18 for. And that was a buy right. Now, if you just own a couple hundred shares, you could sell a covered call to one of them at any time. But what am I going to do? I'm going to look to see how much premium will I get, etc. Yep, when he gets exercised. Okay, covered call. That gave what? Gave him income generation. If the stock drops, he had 45 cents of protection. He owned the stock until what? Until it went deeper in the money, and then they said, we're taking it. Okay. If he wanted to, he could buy the stock again. Now it just jumped to 22. He could buy it again and then sell another out of the money option, or do nothing at all. If the stock stayed around 19, he could sell another 19 if it doesn't get called out. We have a lot of flexibility here. What's the benefit? We're generating income, and time is on our side. Time is on our side. Theta positive. When we buy options, we're theta negative. Theta is always working against you. Time is always working against you. As a seller, we flip it. So what do we have? We have limited upside potential. You saw that in the reward to risk. This thing stops going up. It doesn't matter if it goes up to 1 million. You only make this much. So if you're strongly bullish on a stock, this isn't the best strategy. You're better off buying calls, buying stocks, doing some spreads. This is for slightly bullish. If you're very bullish, this won't make as much money as other things, right? But so it's capped. You have an obligation to sell the stock if it's exercised. Somebody out there exercise their option. And remember what happens. They go to their broker. They say, I want to exercise it. The broker goes, got it. They go to the OCC. They say, all right, we've got somebody exercising. They look at the pool of sellers, of which Stephen was one. And they reach in and they grab his hand and they pull him out. And they're like, dun, 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 you're the short straw. So he doesn't get to be like, you know what? I'd rather stay in. Can you grab somebody else? Bam. It's already happened. He was assigned. They took his stock. They gave him $1,900. He said, thank you for the extra hundy. Moved on. What are the rewards? We get premium, time decay. That's a reward. Time decay. The most consistent element in options is in your favor. Beautiful. Beautiful. What else do we get? Capital preservation through income, meaning we're using that income to help reduce our overall basis and protect against potential downside retracements. Okay. Here are the two comparisons. Buy right. That's what Stephen did. That's what Stephen did. Simultaneously buy the stock and sell the option. You get immediate income. He got that 45 right off the bat. He took the 18 he had to pay. He lowered it by 45. Instead of paying 18, he only paid 17.55. He has the potential to make 155 bucks if it goes above his strike price. Boom. Buy right. Legging in is if Stephen bought it at 18 because he's like, hey, this is at support. This looks pretty good. And he waited. And then all of a sudden the stock's at 19.20. He's like, oh, it's at resistance. Now I'm going to sell the $20 option. Right? Now I'm going to sell an out of the money option. But instead of selling at 19, now he gets to sell 20. And say he gets 50 cents for that. Well, he got the same 50 cents, but now if he gets called out, he gets called out at 20 instead of 19. So you try to let the stock go up and give yourself a little bit more of that appreciation. Selling the call helps kind of lock it in for you when you think it gets to resistance. That's legging in. You acquire the stock first, then you sell a call option a week, a month, a year down the road. There's a lot of flexibility in timing the sale of the call. And what you're trying to do, as we said, is you're trying to allow for a bit of potential appreciation. Buy the stock at support, wait for it to run up to resistance. When it gets to resistance, sell the call. Wait for it to pull back. When it pulls back, you can buy back the call. You can let it ride out, whatever you want to do. But that's the legging in strategy. What are your considerations? Buy right offers immediate income. But you're committed to the option right off the bat, where legging in provides flexibility, but may miss out on immediate premium. Neither's better than the other. They're just different. My preference typically is buy rights. I tend to do these all at once. Now, instead of doing a buy right, what else could I consider? I could consider selling instead of buying stock and selling calls. In fact, a lot of people don't realize, but a synthetic covered call. What does synthetic mean? It means I'm using options to build the exact same trade, but I'm not buying the stock, right? I'm not buying the stock. So I have created a position that behaves exactly like as if I bought the stock and sold the call, but I didn't. A synthetic stock behaves exactly like the stock itself. So essentially, when we're thinking about cash secured puts, we're saying, let's sell the put, but we're not, instead of selling the call, right? I can either buy the stock and sell the call, or I can sell the put. So let me show you what that would look like in Steven's example. Okay. If instead of doing this, he sold what was the put? 2019. If he sold a $19 put, which at the time would have been around $1.45, and let's analyze that. Now, let's make it one contract. Here is, now, this is a covered call. Let's go back in time. He said it was around the 24th. And do I have to take this back to? I don't know why it's not giving me deltas on all this. Yeah, this one is. I want you to notice though, it's about $145 up here. If you look at that, the green lines between this and this, they're very similar. I'm not sure why I'm not getting distinction with the Greeks on this profile here. I should be. Okay. Neither here nor there. We'll have time to go through this in detail on Tuesday. What is a cash secured put? We're selling put options with enough cash in the account to cover if it gets exercised. That's the broker's fear. That's what makes the broker scared of naked puts. I'm not scared of naked puts. The broker is, because if I sell a naked put at, right, if I buy the stock at 50 and sell the $55 call, or I just sell the $55 put. And that's what we're going to do comparisons of on Tuesday, is you're going to see those starting points. What does one starting point versus the other starting point look like? It's just a preference, right? If I sell the cash secured put and the stock stays above the where it's supposed to, I keep the premium and I make the money. Just like Steven's going to have his stock called out, but still make the money, right? What are the differences, the key components of this strategy? We have to have increased cash. We have to select the appropriate strike price, and we have to consider the duration of the put. But those are the same things you're doing with covered calls, right? So that's the big thing, is I don't want you to be like, I would never do a naked put or a cash secured put. Never. And then be like, but I would do a covered call. Well, if you're willing to do one, you're willing to do either. There's not enough difference between them. So what is a naked put? Well, a cash secured put means I have the money necessary for the trade set aside in my account. A naked put would be I have the margin requirement. So if I'm doing cash secured and I have a $50 put, I need $5,000 for every contract, because someone might put it to me for $50. And if they put it to me for 50, right, I'm going to have to pay that. If I have margin, I might only have to pay half of that. I can buy my stock on margin. So then all of a sudden, cash secured, I only need about half of that. So now I only need about $2,500. But if I do a naked put, I'm going to use my margin, and they're saying, oh, we only need you to tie up about 25%. So in that regard, you're only putting up $1,250. So a cash secured put, even though you're holding what you need to buy it, if you have a margin account, it's still going to be less than if you bought the stock and sold the covered call. Using margin, you risk, it's daily interest. Margin interest is really, really quite low, especially if you're used to paying time decay, right? So if I borrowed $5,000 on margin and I get charged, let's say 8% divided by 365, that cost me about $1.10 a day. So if I'm in that trade for 20 days, it costs me $22. There's times where I lose 22 a day in time decay, not right. So that's not terrible. Don't let margin scare you off. We have an obligation to buy the underlying stock. We have limited upside potential, right? My upside potential selling a put is the premium itself. Whatever they paid me, that's the most I can make. If the stock starts at 70 and goes to 150, I still only keep the premium. So again, if you're very bullish, this isn't the right strategy. This is kind of bullish. This is bullish enough, and there's high implied volatility. So I believe that the premiums are overinflated and I want to sell them. You have unlimited downside risk, meaning the stock could drop to zero and you could get hurt all the way down. You got to make sure you understand the margin requirements and the capital reserves. And so we're going to talk about on Tuesday, we're going to do covered call versus cash secured put versus naked put. They're all essentially the same thing. What changes is slightly the logistical requirements for each trade and the amount of margin required for you to tie up in order to do each one. Covered call is the most, cash secured put with margin is second, and then naked put is the least amount of margin requirement. Risks and rewards. The risk when you're selling the put is you're obligated to buy the underlying asset. And so if the market declines, you have a significant risk of the stock dropping, being put to you, and being underwater. What are the potential rewards? You get to collect premium. Again, premium income. Time is on your side. The most consistent variable of options is ticking in your favor. When you sell puts, you also give yourself the ability to buy it at a discount. Let's say the stock's at 52. I sell a $50 put. The stock's at 52 and I'm willing to buy it for 50, right? Or whatever the case may be, I'm going to lower that amount. So whatever I like the stock for, when I sell premium, that amount's going to lower it for me, right? It's going to lower it for me. Now, if the stock is at 52 and I sell a $50 put, I'm selling an in the money put. Unless that stock drops, there's a chance it gets put to me at $50. What do I get paid for it? Well, maybe $3. So anyways, if the market happens to turn down on a put stock I'm not interested in keeping, I'll take the loss and buy back the put cheaper. That's a great call out. What he's saying is if he says, hey, instead of doing a covered call, I'm going to sell the naked put. And then all of a sudden the stock drops. And if he stays there, it's going to get put to him. And he's like, well, wait, I've changed my mind. That's our discretion to say, I no longer want to buy that stock. When it was above 50, I did, but at 48, no, too much. What are we going to do? We're going to wait and try to buy back the put for intrinsic value so we can take the loss, but keep it small and not go through the hassle of buying the stock. Absolutely. Absolutely. Okay. Yeah, it gives us the opportunity to acquire the stock at a cheaper price. Yeah. If I sell right at the money, so let's say the stock's at 55. I sell a $55 put when I get $3 for it. Anything above 50 and the stock's going to get put to me, right? Or excuse me, anything below 50, it's going to get put to me. So if the stock's at 54, they're going to put it to me. But if I have a $55 strike, I get to take 55 minus 3. My cost basis is 52. So if the stock's at 54 and it gets put to me at 55, I'm okay with that because I actually own it at 52. And now I can turn around and sell a $55 call and get another $3. And now my cost basis drops to 49. So now I'm at 49. And if all of a sudden I get called out at 55, I made $6, $6 on a $55 investment. That's 12%. 12%. right? 8% in 1 month, 12% in 45 days. Are we knocking it out of the park? No. But if you're taking large chunks, 30, 50% of your money, and you're able to produce 40, 50% over the year on covered calls and naked puts, I mean, that alone is having a 20 to 25% impact on growing your entire portfolio. Add some more from your speculation and you have a great year. That's what this is doing. It's bringing a different strategy. So diversification by strategy. It's bringing time decay in your favor, which is always something that we would prefer to do. Summary, recap, covered calls offer income, some downside protection. Selling puts can generate income, provide opportunities to acquire stock at a lower price. Effective management means understanding the downsides of each and implementing safeguards. Prioritize comprehensive knowledge of both covered call and put strategies, selling put strategies to make informed decisions, optimize outcomes. What are we going to do next? Next thing we're going to do on Tuesday, we're going to take a stock and we're going to say, hey, here's how I would do a covered call. Here's how I would look at the covered cash secured put. Here's the naked put. And we can look at what the margin requirements be, what everything else would be. So we definitely want to do a couple of examples. Until then, what are your questions? They don't have to be about today's material, but I have to imagine if you've never done covered calls or selling options before, you're a little bit like, oh, my head is spinning. Remember, building blocks. We started as buyers. We have rights. Today, we're talking about sellers and obligations and how somebody has the right to call us out of the stock that we own. Or if we're using puts, somebody has the right to sell it to us at a certain price. We're obligating ourselves. But it's around our ownership of stock. So if we can get 4 to 6% premiums in addition to some capital appreciation, we can do quite well. Steady Eddie. This is a tortoise race. This isn't a sprint. Steven said, you're welcome to get on Discord. He'd be happy to discuss covered calls or cash secured puts. Someone said something about getting the stock for free. Well, theoretically, if you kept selling premiums and covered calls, you could eventually sell enough covered calls and naked premiums that you own the stock, but that's a lot of work. I mean, you're maybe getting 3 to 5%. So let's say you average 4%, it's going to take you a couple years. Right? A couple of years. Without sounding disparaging of someone I don't know, it sounds a little bit marketing-ish to me. Like, oh, well, free stocks all around. Just look under your chair. Free stock for you and for you. But no, essentially they're saying you got to sell premium, lower your basis. Eventually, if you lower your basis to 0, it's free. Huzzah! Sounds fun though, right? What else? What other questions? Discord. Yeah. So I'm going to change what we have into a Discord community. That's going to give me a stage. And that's where I think I'm going to do our presentations may all be on Discord soon. We won't have all these links and all that nonsense. You just pop on Discord, boom, you jump on, watch the stage. I'm looking at creating sub rooms, an options room, a technical analysis room. I've spoken with Gary and Glenn. They're going to come in and help moderate. We're going to create some events, some Discord events. So we'll have a lot more in there. And that way, if you're forced to be in there anyways, maybe you'll start using the added benefit of working together as a community. There's some great traders willing to share knowledge, willing to discuss trades. So that I'm working on the logistics. Apparently we had an issue with something that will be resolved. I'm not going to wait for the alerts because they're like, yeah, it's coming. I'm like, okay, I've heard that. So I'm just going to relaunch and then we'll add SMS when we can. So we're trying to have some things coming out next week that we're very excited about moving forward with. Next week, Options Foundations continues. All right. Any other questions, or is everyone feeling pretty good about where we stand? We're ready to build some of these things, see it in action, maybe place a paper trade or two. That's what I would recommend for you who is trying to learn the strategy, do some paper trading with it. That's free experience right there. Okay, I will see everybody tomorrow. Yeah, let's hope for a good market day. We will meet at 3:15 p.m. Eastern time for our weekly market wrap up. Be there. Let's have some afternoon coffee, a little market chat before we wrap things up. I hope you have a great rest of your evening. Or if you're down under, I hope you have a great day. And I will see everybody tomorrow. Thanks and happy trading.